we are 2 weeks into the new year, and now that the dust has settled with what happened with inflation and unemployment, I think it's important to revisit a lot of those mortgage and real estate forecasts, especially if you plan on making a purchase in 2025. Now, for those of you who are new to me, my name is Lizy Hoeffer. I work for Cross Country Mortgage, and I've been in real estate now for 22 years. And the reason that that's important to you is because you're going to find a lot of content on the internet, specifically YouTube, and now an influx of content creators from TikTok that talk about the housing market. And I will tell you, not all housing content creators are made equally. A lot of them are mortgage and real estate professionals with limited experience. And I will tell you that very few of them are actually housing analysts. Most of them are looking for views. Most of them are looking for leads. And rarely are they giving you information that will help you make a smart, informed money decision. Now, having said that, I want to go into what the projections actually were. Now, depending on the source, expectations for first quarter mortgage interest rates were anywhere between 6.6% and 6.2%, and they drop all the way down to 6.25% to 6.3% by the end of the year. Now, I would say that based on the data, these are pretty conservative expectations for what interest rates will do. I know that there's a lot of housing economists and housing analysts that actually predict that interest rates will be in the 5s. Now, I have not seen a single analyst or a single economist predict interest rates in the 3 or 4%, but I am seeing that a lot of actual housing experts are thinking that interest rates might be lower than this. This was all based on information about where the economy was headed towards the new year. And there were a lot of people that actually expected that we would see a rise in unemployment to 4.3% or greater, and that we might see rising inflation. And what's interesting is literally the exact opposite happened. We saw a decline in unemployment and we saw a decline in inflation. Now, how does that impact the mortgage rate predictions? Well, there's a couple of important aha moments when you're looking at what happened with interest rates. So we did see, and you might have read the catastrophic headlines that said interest rates were now the highest level that we saw since May of 2024. And the reason that they do that is because they're looking for time frames when they can sensationalize headlines. And so the highest interest rates since May of 2024 were actually interest rates close to 7.25%, which has been basically within the range of mortgage interest rates for almost the last year, which consumers are already used to. And I'll talk about why that is later. But we saw interest rates jump up to right around 7.25%. And this was based on the catastrophic news that unemployment was weakening and that we had a way more stable employment market. Now, why that matters? Well, it matters because there's a lot of people with multiple jobs or part-time jobs, and affordability is at an all-time low. And so because they've been raising that Fed funds interest rate to make things more expensive for businesses, you would expect to see higher layoffs and then Fed intervention to create stimulus, which would then lower the costs of things like mortgages. And we just didn't see it. So it felt like, a catastrophe for those of us who work in real estate, but the market impact of the unemployment rate was fairly mild. So I want to talk about what happened with inflation, because we saw, quite frankly, the opposite numbers happen for the inflation reports. So the expectation was rising inflation, which we did have, but it came in under expectations. So it was lower growth than expectations. And inflation has been this big, pesky issue that we have seen for the last couple of years. It's been the reason that mortgage interest rates have risen so high and made housing so unaffordable. And so when you hear positive inflation news, the expectation is that now things are becoming more affordable, but inflation is really just the rising cost of goods and services. So even though they've come in lower than expectations, they're still increasing costs. And so affordability is still an issue. That being said, the positive news sent the market back into a rebound. Interest rates dropped into their December lows, which was roughly around 7%. Now, the reason I bring this up is because if this had been the headlines and we were in 2023, we would have seen interest rates approach 8% or higher. This was the kind of news that would send the market into craziness. And one of the most positive things to happen to 2025 so far has been a relatively stable mortgage interest rate market. Now, I'm sure that there are a lot of people that are like, I'm not that excited about 7% rates, but I will say that stability is the very first stepping stone, the foundational piece to a healthy rebound in an investment, right? So when pricing stabilizes, you can build upon that. And so from here on out, I expect interest rates to drop and then rise, but the volatility level not to be like, the Grand Canyon, right? It should be like small stepping stones. And so for me, this is very exciting. And and it says a lot about economics. And so for people who are very educated on economics, the Fed funds rate, the 10-year Treasury note, and the spread, which is really just the risk differential between a mortgage-backed security and a 10-year Treasury note, they will be the best ones to follow when it comes to mortgage interest rate forecasting. So I'm going to be pretty bold and say that the mortgage interest rate projections from Fannie Mae and the Mortgage Brokers Association and even big banks like Wells Fargo is pretty conservative. And that's because they're using Q3 data, and they're also trying to be pretty conservative as it relates to what might happen with unemployment. So most economists pretty much agree that unemployment would have to get to 4.3% or worse for the Fed to really intervene with buying mortgage-backed securities and lowering the Fed funds rate. Because we saw it drop in January, people are worried that it might not happen. But one of the big things to consider is, again, where you get your information. And because I study mortgage housing analysts, economists that are specific to housing, some of the things that they're looking at actually have to do with where we see unemployment increases right before a recession or right before we see a dramatic increase to unemployment in general. And typically we see that in manufacturing jobs, which we already saw a reduction to in 2024. And the next thing really to follow is residential construction. And what's interesting is that you see housing permits and new housing starts pretty much the lowest they've been since COVID and the Great Recession, which is pretty much a precursor to residential layoffs. Now, I don't know if there is going to be an impact to this due to the fires in California, but I think that there is substantial enough information to believe that we could see layoffs in residential housing. So typically when you see a reduction in force in manufacturing and residential housing, typically it's then followed by a recession. Now, whenever people mention the word recession, there are a lot of people that will then jump to, oh my God, there's going to be a housing crisis, there's going to be this big market crash. And that is because there is a ton of content and a ton of headlines regarding market crashes and real estate all of the time. In fact, it has existed my entire career. And those people that create content to fearmonger, they should be ashamed of themselves. And for you, the consumer, just because somebody can identify a coincidence in a data point from one market to the next does not make them an expert or a housing analyst or somebody qualified to tell you whether or not to make an investment. In fact, all of those people that were predicting housing crash after housing crash back in 2018 to 2021, they cost you 30% or more in equity return on an investment that you could have made at 3%. And so those people should be ashamed of themselves. And as a consumer, you really have to figure out, is this market really similar to the Great Recession? And I will tell you that from a data standpoint, no. We have historically low delinquencies forever, for all of history. In addition to, we have more than 50% of people who own a house own it free and clear. And of the people that have a mortgage, most of them have equity positions greater than 40%, meaning that they have a ton of equity before it makes sense for them to have to dump their property or short sell. And so I'm not saying there isn't an opportunity for you to buy a property that's a foreclosure or a short sale. I'm just saying that housing values will not go down if there is a pullback. And there was only one recession in the history of the last 5 recessions that brought housing values down. And that was the recession that was literally caused by real estate. So what is my overall outlook for the 2025 real estate market? I think it's going to be very stable as it relates to mortgage interest rates. And because of that, we are going to see more and more consumers feeling comfortable buying and applying for real estate. We've already seen this with mortgage applications rising, refinance applications rising. Consumers are used to rates in the 7%. Now, I do think that there is a lot of economic data that could lower interest rates and lower interest rates quickly. I think if energy costs go down, I think inflation goes down, mortgage interest rates go down. I think that if we see an increase in unemployment, I think interest rates go down. And so when that happens, realize that there is a lot of buyers on the sidelines waiting to re-enter into a more affordable housing market. I think the data shows that there's like 3 to 5 million Americans that will buy if interest rates are at 6%. And the majority of buyers that are waiting on the sidelines for a better opportunity will jump in at 5.5%. We are away from that, but we aren't like catastrophically away from that. Look, I know when interest rates are at 7%, 5.5 sounds like a fairy tale, But the thing is, based on my experience, is that markets change a lot quicker than people expect and people time. And by the time most people are aware that it's a good and more affordable time to buy, their market leverage has left them. And it's a lot different of an environment than most people expect. It's like you got to follow Warren Buffett's advice here. You buy when no one else is buying, but only when your budget says it's ready. And a budget is ready when you can safely afford the mortgage payment, you can safely afford your lifestyle, you have money to pay down debt, you have money for savings, right? It isn't something that's going to make you house poor. And if that is you, you should absolutely buy, and you should plan on holding. Timing the market only costs people, guys. It costs them in paying higher interest. It costs them in leverage. People who have bought with 7% rates got all of their closing costs paid for, or got a 2-1 buy down to make temporary lower payments, or got a reduction in price. And so those are the people that will actually have a much better return on their investment than, let's say, people who were buying in 21 and 22 and then potentially 23 when the market had already passed them. Anyway, pay attention to this channel because I'm going to be putting a lot more content out there about money strategies, the economy. I'm going to throw in a little bit of lifestyle for those of you who follow me for sales tips. Let me know what I can answer for you in the comments below, guys, and don't forget to tune in to another video in the future.